In this video, we're working through some Chapter 11 notes. Chapter 11 was titled Performance Measurement in Decentralized Organizations. Before we get started, I just wanted to make sure we take a second to talk about decentralization, what it means. So in this context, we're really just describing organizations who have decentralized decision-making capabilities. So given how the organization is set up, whether they have different product lines, segments, and so on, they've pushed decision-making authority to lower-level managers. So there's potential benefits to doing that rather than centralizing decision-making and having executive management make all decisions. And some of those benefits include the things that are thrown in the boxes here. So lower-level managers do gain experience in decision-making. Hopefully we can promote from within and retain our good talent. And so if we've empowered lower-level managers to make decisions in the course of their regular duties, they'll be tomorrow's executives. So in theory, that should give them some good experience. Top management is freed up to concentrate on strategy. So rather than worrying about the minutia of some of the operational decisions, the executive level can really worry about that strategic stuff that's going to position us for better competitiveness in the marketplace. Lower-level decisions are often based on better information. We've talked about this a few times this semester. Lower-level managers are more intimately familiar with their part of the organization and their operations specifically, so they, in theory, should have the best information from which to make decisions about their part of the organization. Moving along with that, lower-level managers can respond more quickly to customers. Again, they work with those folks on a regular basis. They know them better. They know what they need better. So in theory, they should be able to respond more quickly to customer needs. Decision-making authority leads to job satisfaction. That fits in with really some of the other points we've already discussed. If we're empowering lower-level managers to make decisions about their parts of the organization, they're probably a lot happier about how things are running. And then I added this one. It's not in your textbook, but from accounting and organizational behavior research, a lot of things would suggest that decentralization, and this fits partly with the box in the lower right, increases group identification, which can boost performance and things like cooperation, commitment to group goals. It can reduce turnover intentions. A lot of these things that we might associate with job satisfaction, but that's been explicitly demonstrated in research. There's potentially some disadvantages, though. Lower-level managers might make decisions without seeing the big picture. Again, they've got the best information about their smaller part of the organization, but they might not completely understand or think about how that fits in with the bigger picture of the organization. There may be a lack of coordination among these autonomous managers. I drew a little line to this other one because they somewhat relate. It might be difficult to spread innovative ideas or improvement suggestions, in other words, in the organization. If everyone's only worried about their small part of the organization, they might not, again, be thinking about how they can get sort of everyone working better together. Then over on the bottom left corner here, lower-level managers' objectives may not be those of the organization. And that's somewhat related to the other points we were just discussing as well. Again, if the lower-level managers are only focused on how they can make their small part of the organization run better, they might not be seeing how that fits in with the organization's objectives as a whole, particularly as those things change over time. We've discussed responsibility accounting at several points this semester, and finally here in Chapter 11 we kind of think of some of the nuts and bolts of it in a traditional sense. So responsibility accounting, as we know, is really just trying to make sure that we're making decisions such that people are being held responsible only for the things within their immediate purview, or those things they have some control over. So we introduced this term of responsibility center, and it's really any area of the organization or part of the organization or part of our operations about which we want to make some kind of determination of profitability, cost effectiveness, or investment efficiency. So we have three different types of responsibility centers: a cost center, a profit center, and an investment center. A cost center is a segment or a part of the organization whose manager has control just over costs, but not over revenues or any investment funds. So some of the support functions within organizations would certainly be considered cost centers. Things like information technology, legal support, human resources, they have plenty of costs, and they're certainly critical to running an organization, but their managers don't have any control over revenues, and they may not even have control over investment funds, investment in equipment and land and property and any of our kind of capital investment type things. A profit center, on the other hand, is a segment whose manager has control over both costs and revenues, but no control over investment funds. So some examples there, we might say a retail store. So if you go into your local Bed Bath & Beyond, for example, the manager there has some control over costs in terms of staffing decisions and potentially some other things related to local operations, and certainly revenues, sort of generating sales, but they don't have any control over investment funds. They probably can't make a decision to expand the store or build an addition without some kind of corporate decision making involved. And then finally we have an investment center, and that's a segment whose manager has control over everything. Costs, revenues, and then investments and operating assets as well. So they can make the big strategic decisions about expansions and investment in capital equipment and things of that nature. So our learning objective 1 was to calculate return on investment and then show how changes in sales, expenses, and assets would affect that performance measure. So return on investment we can calculate simply as net operating income divided by average operating assets. And usually when that measure is used, net operating income is expressed as income before interest and taxes, because we really want to focus on controllability, and things like interest and taxes not often that controllable. And then average operating assets includes cash, accounts receivable, inventory, plant and equipment, some are capital investments, and then other productive assets, but not quote-unquote non-productive assets. Most companies do use the net book value of depreciable assets to calculate that average operating assets. And just thinking back to accounting principles, remember net book value is the historical cost minus that accumulated depreciation. So this thing really could change over time, right? As assets age, that measure is going to get smaller and smaller. So ROI we can express not just as net income divided by average operating assets, but we also can determine it based on two different measures, margin and turnover, which are in their own right measures of certain productivity and performance. So margin is calculated as net operating income divided by sales, and that's an expression of the portion of sales dollar that makes it all the way through to the bottom line. Right? So if we had a margin of 5%, fairly low, we're saying 5 cents on every dollar makes it through from sales all the way to that bottom line net income. Turnover we can calculate as sales divided by average operating assets, and that's a pretty good measure of productivity in terms of generating sales using those productive assets. In other words, how many times do we turn over in a given period our particular assets? That can sometimes indicate potential productivity within any particular division or segment. And again, ROI, we can also calculate then as the product of those two other measures, margin times turnover, because we can see those terms they have in common. So let's think about changes to ROI. Let's use an example to illustrate this. So Regal Company reports the following: net income $30,000, average operating assets $200,000, sales of $500,000, and operating expenses of $470,000. So what's their ROI? Well, it's margin times turnover if we want to think about it in those terms. Margin being net income divided by sales, turnover being sales divided by those average operating assets. So if we plug in the numbers here, we've got the margin term, net income divided by sales, or 6%. The turnover term, the sales divided by average operating assets, or 2.5, for an ROI of 15%. Now assume that Regal's manager invests in a $30,000 piece of equipment that increases sales by $35,000, but also increases operating expenses by $15,000. So now we're reporting the following. Net income 50,000, average operating assets 230. They've added that piece of equipment. Sales of 535 because those have jumped up by 35,000. And then the operating expenses have increased to 485. So we're going to calculate their new return on investment. Again, margin and turnover, we'll do that separately for this example. Margin, the net income divided by sales, is now 9.35%. The turnover, the sales divided by average operating assets, now 2.33. So total ROI has increased to 21.8%. So a pretty significant jump with this one relatively small investment in operating equipment that seemed to bump up sales but also increase expenses. So ROI has increased in total from that 15% to 21.8%. There are a few criticisms of ROI. So in the absence of the balanced scorecard, which we talk about later, management may not really know how to increase ROI. And that may sound a little oversimplified, but sometimes it is hard to determine exactly what effect investments will have on return on investment just in total. There's a lot of other factors that go into how those things change. Sales and expenses, and sometimes managers can't keep all that in sort of the big picture. Managers often inherit a lot of committed costs over which they have no control. So if you think about what goes into that measure of ROI, we've got things related to pretty substantial investments in equipment, plant assets, and things of that nature. If a new manager comes into a particular division or segment, it's probably going to be a whole bunch of years before they could ever really control some of those old committed costs and those old assets. And then managers evaluated on return on investment might reject profitable investment opportunities. And this is referred to as the classic underinvestment problem. And we have some examples to illustrate that, but to hit on it for just a minute now, if you are being evaluated based on your return on investment, you're a manager of a particular division, if your current ROI is, let's say, 20%, and you get a new investment opportunity that you think will return 15%, you're probably going to reject that investment opportunity because it would lower your overall ROI, even though it's a pretty profitable project. So we refer to this as the underinvestment problem, and we'll look at that in some examples. So let's have a quick ECO here. A potential advantage of using ROI to evaluate performance is that it encourages the manager to reduce the investment in operating assets as well as increase net operating income. Think about that for a second, pause this, and then we'll hit the answer. That's probably true. Now, I know sometimes it seems counterintuitive to think about reducing investment in assets as being a good thing, but sometimes we do want to get leaner. Sometimes we're sort of bloated with our investment in capital projects. And so thinking about how that overall level of investment affects ROI can be a potential advantage to using it. How about one more question here? All other things the same, an increase in unit sales will normally result in an increase in the return on investment. Again, pause it for a second and then give it a quick thought. The correct answer there is A, true. So if we're boosting sales and nothing else is staying the same, then we should be boosting net income. We shouldn't have had any change in our operating assets, so we shouldn't have any change in that component of the return on investment calculation. So we should be increasing that return on investment. Next question. Tennell has a $1,400,000 investment opportunity with the following characteristics: sales of $4.48 million, a contribution margin ratio of 40%, fixed expenses of $1,657,600. So what's the ROI for that investment opportunity? Give this a quick pause, do the calculation, and then check your answer. The answer there is D, 9.6%. So we want to find net income first. We've got the sales of $4,480,000 times that CM ratio of 40% to figure out what total CM would be, minus the fixed expenses will give us that net income of $134,400. So then our ROI is that net income divided by the asset, the $1,400,000 investment, and there's a return on investment of 9.6%. Now it's worth noting here, we can't say necessarily whether that's good or bad yet. It's better than return on investment of 5%, but we don't know what that division or what that company is currently doing. Maybe all their other projects have ROIs of 15% or 20%, so maybe this is a step backwards. We don't have enough information to make that determination, but it is at least a potentially profitable project. It recorded some positive return on investment. Another question here. Redmond Awnings, a division of Wrap Up, they have a net operating income of $60,000, average operating assets of $300,000. If the manager of the division is evaluated based on ROI, will she want to make an investment of $100,000 that would generate additional net income of $18,000 per year? Give that one a quick thought. Pause the video here and then come back for the answer. So the answer there is no. So we have to think about what the new ROI would be, sort of what the ROI change would be relative to what they're currently doing. So the new ROI would be $78,000. That's the old net income of $60,000 plus the new $18,000 that would be generated by this project, divided by the new average operating assets of $400,000, the $300,000 plus the new investment of $100,000, and that would be 19.5%. That actually lowers the division's overall ROI from 20%. Remember, that was the old net income of $60,000 divided by the average operating assets of $300,000, down to the new level of 19.5%. We'd also know that by taking the net operating income generated from the new investment, $18,000, divided by that new investment of $100,000, and that's 18%. So we'd know, well, that's less than their current 20%. That would make it not very attractive if we're being evaluated based on ROI. Learning objective 2 was to calculate residual income and understand its strengths and weaknesses, in particularly relative to return on investment. So residual income is another popular performance measure. It's net operating income above some minimum return on those operating assets we've been talking about. So we calculate it as the net operating income for the period minus the average operating assets times whatever minimum required rate of return is set for that division or segment. So pretty significant difference from ROI, right? ROI measures that net income earned relative to the investment itself, since it scales income by the investment, whereas residual income says, well, given what our minimum return is, how much above or below that am I generating in income? On average, or all things equal, residual income at 0 or above 0 is considered acceptable, because even if residual income is exactly 0, it would be returning exactly the minimum required rate of return that we've set for any particular division or segment. So we'd say that that's potentially profitable if they're meeting their required rate of return. So let's look at a quick example here. The retail division of Zephyr has average operating assets of $100,000, and they're required to earn a return of 20% on those assets. In the current period, the division earns $30,000. So residual income is going to be their actual income, $30,000, minus that minimum required return. So that's 20% on the assets of $100,000 or $20,000. And there's our residual income then of $10,000. So we'd say they are earning above their minimum required rate of return. Their residual income is positive, so they're potentially profitable. Residual income encourages managers to make profitable investments that would be rejected by managers using ROI. And we hinted at this earlier when we started to think about ROI. Whoops. So we said in our one practice problem that one manager wouldn't accept the 18% ROI project because it would lower her overall ROI. Well, if we use residual income, managers, in theory, are going to accept any project that returns at least that minimum required return we've set. Anything that hits that residual income of 0 or above. So in the case of that previous example, and we'll see it in just a second here, it might change our decision. So again, this is a similar setup from last time. The company's required rate of return is 15%. Would the company want the manager of the Redmond division now to make an investment of $100,000 that would generate additional net income of $18,000 per year? So pause that for a second, give it a quick thought. And the answer there is yes, right? The return on investment's 18%. So thinking back to our previous practice problem, that lowered the division's overall ROI, but this return on investment exceeds the minimum required rate of return. So that residual income is the $18,000 generated by the project minus 15% times that investment of $100,000, and there's our positive residual income of $3,000. So all things equal, if we're evaluating the manager based on residual income, they'll now want to accept this project. Let's try another practice problem. So Mike Corp uses residual income to evaluate the performance of its divisions. In January, commercial products had average operating assets of $970,000 and net operating income of $143,700. Residual income for the same period was $7,900. What must Mike's required rate of return be? Give that a pause, try to make that calculation, and then come back for the answer. The answer there is 14%, so we've got to work a little backwards. Thinking about residual income, it's the net income minus the average operating assets times that required rate of return. So it's the $7,900 residual income here. Net income was $143,700 minus those assets of $970,000 times that unknown required rate of return. So when we do some rearranging, we get $135,800 equal to the assets of $970 times that unknown required rate of return, and we end up with required rate of return of 14%. There is one potential disadvantage to residual income that we want to keep in mind. It can't generally be used to compare the performance of divisions of different sizes, at least in a meaningful way. Let's use an example to illustrate that. So from Zephyr here, recall the following information about that retail division. We've got the operating assets of $100,000, required rate of return of 20%, so their minimum required return is $20,000. Let's assume we have the following information though for the wholesale division. It's 10 times as big in terms of assets. Got $1 million in operating assets, the same required rate of return of 20%, so their minimum required return in dollars is $200,000. Again, we have the information given for the retail division previously. Let's assume that the wholesale division had actual income of $220,000 in that same period we were looking at the retail division. Minus their required return of $200,000 would give them residual income of $20,000. So if we're looking at them side by side, we're saying, oh, well, the wholesale division's generating more residual income, so maybe they're doing a better job. But their division, again, is 10 times as big in terms of assets, so they should be generating a whole lot more income. Now, yes, it is offset partly by that greater required return in dollars, but their residual income is greater than the retail division, really just because they're a bigger division overall. So if we looked at ROI, the retail division would have ROI of income $30,000 divided by assets of $100,000, or 30%, versus the wholesale division, which would have income of $220,000 divided by assets of $1 million, or 22%. And really, the retail division is earning a greater return on their investment than the wholesale division. So we just want to be careful about how we use these performance measures. Residual income doesn't really let us compare divisions of different sizes. Return on investment does a better job with that. It kind of standardizes that return. Learning objective 3 was to calculate throughput time, delivery cycle time, and then manufacturing cycle efficiency. So we're not going to do a lot with these, but I did want to just step through them quick. So if we're thinking about a production process and sort of the time we get a customer order to the time the goods are shipped, there are a whole bunch of things happening in the production process between that. So we call the wait time, that time between when the order is received and when production started. From the time production is started to the time goods are shipped is called the throughput time, and that's going to include processing time, inspection time, move time, and queue time. And everything together is called delivery cycle time. Process time, it's worth pointing out, is really the only value added time. All these other things aren't adding value to our product. So our measure of manufacturing cycle efficiency is the value added time, that process time, divided by the overall manufacturing cycle time. Learning objective 4 was to understand how to construct and use a balanced scorecard. So the balanced scorecard is a performance measurement tool that encompasses performance measures along a whole bunch of different dimensions. So really management is trying to translate its strategy overall into performance measures that employees in theory should understand and also be able to influence, again, along several critical dimensions, like financial, internal business processes, customer, and then learning and growth. So let's talk a little bit more about some of those. So financial measures, really we're trying to get at things that would capture, has our financial performance improved? And if we think about the translation from the vision and strategy of the organization to those measures, we'd see sort of this top rung here. So the vision and strategy, what are our financial goals? How are we going to measure profitability? What rates of return are we looking for? Things like that. That will translate into some kind of financial performance measures that will get to that question. We look down one rung here to customer. We're asking, do customers recognize that we're delivering more value? And how that would translate from the vision and strategy. Considerations like, what customers do we want to serve? How are we going to get them in a competitive marketplace? And how are we going to keep them coming back to our product? Moving downward here, internal business processes. Have we improved key business processes so we can deliver more value to customers? Again, are we always getting better? So if we think about the vision and strategy and what questions would translate to those measures, we'd be asking things like, what processes are critical to providing value to customers? What processes do we want to be getting better at, improving on a continuous basis maybe? And then last but not least here, learning and growth. Are we maintaining our ability to change and improve? And that would be both from a sort of talent standpoint, our employees, and just the organization as a whole. Are we sort of learning and growing in the marketplace, developing innovative products? So the balanced scorecard does rely on non-financial measures in addition to financial measures, and for at least two reasons. Financial measures, we call those lag indicators, because typically they're summarizing things that have happened in the past. What return did we get on investment from last period? Whereas non-financial measures are potentially lead indicators of future financial performance. So things like customer satisfaction is an indication, of course, of how satisfied customers are with our current products and services. That's a potential indicator of how likely they are to come back. So that's a potential lead indicator. And then second, top managers are ordinarily responsible for the financial performance measures, but not lower level managers. So non-financial measures are more likely to be understood and controlled by our lower level managers, those folks that are in the different segments and sub-segments of our organization who have the better information about how their part of the organization works. They're more in tune with the customers they might work with their suppliers, and so on. So we want to make sure we have appropriate performance measures for all of those pieces of the operation. Another point to make here is that the entire organization should have an overall balanced scorecard, but then each individual manager should also have a personal balanced scorecard. And the personal scorecard should contain measures that really can be reasonably controlled by that individual manager who's being evaluated with its use, and that support the measures in that overall balanced scorecard. So we want individual managers to understand how their performance and how their segment's performance contributes to the overall goals of the company. We also want to make sure consistent with this idea we're always talking about with responsibility accounting, that individual managers are only held responsible for things that they can reasonably control. A balanced scorecard should definitely have measures that are linked together on a reasonable cause and effect basis. Just saying if we improve one performance measure, then, for example, another desired performance measure will improve. So if we improve customer satisfaction, for example, then sales or profitability will improve. So the balanced scorecard really tries to lay out concrete actions to kind of be able to reach these outcomes. Incentive compensation should definitely be linked to balanced scorecard performance measures. And again, we're not saying we only want to link those to the financial measures. We want to make sure we're linking compensation to all the performance measures, both financial and non-financial. So let's take one example here, Jaguar. They make luxury vehicles. And let's think about how some of these things fit together. So some financial measures of performance might be things like profit and contribution margin per car, right? Some cars more profitable than others. Customer measures might be number of cars sold. I know that's somewhat financial as well, but we think about sort of gaining market share. And then also things like customer satisfaction with options or with different types of vehicles that we're currently selling. From a business process standpoint, we might have measures like number of options available. Are we able to provide changing needs to customers? Are we able to adequately identify customer needs and wants in the marketplace, trends in these things? And then also time to install options. And then from a learning and growth standpoint, maybe we think about things like employee skills in installing those options, those new options. So thinking about some of the ways we might look to improve things and how that relates to our performance measures, one of our strategies might be to increase the options available to customers. And that relates to that performance measure of the number of options available. We might also say, well, we need to increase the skills of our employees. That measure we had for employee skills in installing options. Maybe results have shown that one's a little bit behind where we think it should be. So as we make those changes, we'll hopefully start to see the effects of those things sort of cascade through this value chain and through this through these links of performance measures. So results we'd be looking for would be, time decreases in that time to install option. That would result from increasing employee skills. We'll also be looking for satisfaction increase in those customer satisfaction performance measures as a result of increasing the options here that customers want. Again, with satisfaction increases, we'd be looking for increases in the number of cars we sold. With that, we'd be looking for contribution increases in the contribution per car measures, right? Saying, well, what's making these things more profitable per unit? So as we see time decreases in these time to install options, customers are more satisfied, we sell more cars. As an indirect result, each car is more profitable in theory, and then hopefully leading to more profit at the top there. So if the number of cars sold and the contribution per car increase, again, profit overall should increase. So that's how we're trying to fit some of these performance measures together and some of the things we might be using strategically to improve those performance measures. And that's what the balanced scorecard can do for us. We did have an appendix in this chapter to think about. That was Appendix 11A around transfer pricing. So a few concepts to think about first. A transfer price is really the price charged when one particular part of the organization sells or provides goods or services to another part of the organization. It's an internal movement of goods or services. So the fundamental objective in setting transfer prices is to make sure that managers are motivated to act in the best interests of the company as a whole. We want to focus on what decisions internally are making the overall profitability of everyone combined better, as opposed to just one segment or another segment kind of winning. So there's three primary approaches to setting transfer prices: negotiated prices, transfers at the cost to the selling division, and then transfers at market price. Our official learning objective was to determine the range, if any, within which a negotiated transfer price should fall then. So the negotiated transfer price results from discussions between the two divisions who are trading the good or service. So some potential advantages there is that this type of transfer pricing preserves the autonomy of the divisions, and that's consistent with the spirit of decentralization. Again, we're empowering the managers in this scenario to say, hey, figure it out amongst yourselves, figure out a fair transfer price for something. The managers negotiating that transfer price are likely to have the best information about potential costs and benefits of the transfer than anyone else in the company. So the part of the organization that's transferring the good or service to the other part knows more about the demand for their product or service in the overall marketplace. Again, we don't want one part of our organization kind of suffering while another one reaps the benefits of some kind of internal transfer. We want to make sure this thing is as fair and equitable as possible and that everyone combined is better off. So if we think about the range of acceptable transfer prices in this scenario, the upper limit's determined really by the buying division and the lower limit's determined by the selling division. It's that negotiated transfer price in the middle. Let's use a quick example here. So assume this information shown with respect to West Coast Plantations and Grocery Mart, which are both companies owned by Grocery Storehouse. So the West Coast Plantations, their orange capacity per month is 10,000 crates. That's what they can harvest. They have a variable cost per crate of $10, fixed cost of $100,000, and the selling price on the outside market is $25 per crate. Grocery Mart, on the other hand, the current purchase price of navel oranges is $20 per crate, and they sell 1,000 crates of this stuff every month. So the selling division, that's the West Coast Plantations, their lowest acceptable transfer price is calculated here. It's going to be greater than or equal to the variable cost per unit plus the total contribution margin they would lose on outside sales to transfer it internally, divided by the number of units transferred. So let's figure out what that lowest and highest acceptable price would be under a few different scenarios. So the buying division's highest acceptable transfer price would be less than or equal to the cost of buying from an outside supplier. Again, we don't want to sort of boost sales for one segment at the detriment of another segment who can get it cheaper outside the company. If an outside supplier doesn't exist, though, the highest acceptable transfer price would be calculated as shown on the bottom here. The profit to be earned per unit sold, not including that transfer price. So if West Coast Plantations has idle capacity, 3,000 crates, to satisfy Grocery Mart's demand, 1,000 crates, without sacrificing sales to anybody else, the outside market, then the lowest and highest possible transfer prices are shown here. That selling division's lowest possible transfer price, the $10 variable cost per crate, plus nothing that they're losing from the outside sales, so $10 overall. The buying division's highest possible transfer price, again we said, well, that's less than or equal to the cost of buying from the outside supplier, so that's the $20 per crate that they can get it in the market at. So we'd say the range of acceptable transfer prices is that $10 to the $20. If West Coast Plantations, though, has no idle capacity and has to sacrifice other customer orders, the 1,000 crates, to meet Grocery Mart's demand, then that changes the scenario. So then the selling division's lowest possible transfer price is still the $10 variable cost per unit, plus now the contribution margin on the lost sales. So $25 minus the $10 times the 1,000 crates they're giving up selling to the outside market, divided by the 1,000, and that's a total of $25. The buying division's highest possible transfer price, on the other hand, is still that less than equal to that cost of buying from the outside supplier, or $20. So in this case, we'd say there's no range of acceptable transfer prices. In other words, if we transfer this internally, the company as a whole is going to be worse off, because we'd have the one division buying from this division at $25 when they could be buying from the outside market at $20. We don't want to make everyone worse off just to transfer this internally. If West Coast Plantations has some idle capacity, let's say they have 500 crates of capacity, and so they still have to sacrifice 500 crates of outside orders to meet Grocery Mart's demands, then we have again another change to the potential range of transfer prices. That selling division's lowest possible transfer price is the $10 variable cost per unit, plus the contribution lost on the outside sales. So 25 minus 10 times the 500 crates of external sales we'd have to give up, divided by the 1,000 crates overall that we'd be transferring, and that's $17.50 per crate. Now the buying division's highest possible transfer price is still the $20, still the cost they can get it from the outside supplier at. So now the range of acceptable transfer prices is the $17.50 to the $20. So if a transfer within a company would result in higher overall profits for the company, that means there's always a range of transfer prices within which both divisions would have higher profits if they agree to that transfer. And that's what we're shooting for. Right? We want to make sure again that our internal transfers don't hurt any particular division, and certainly that they don't hurt the company as a whole. So if managers are pitted against each other rather than against their past performance or some kind of benchmark, then we'd say that all things equal, we're probably sort of generating a non-cooperative atmosphere there. And given that disputes that accompany the negotiation process, a lot of companies rely on some other means of setting transfer prices. So in theory, it would be great to trust managers to be able to complete those negotiations in a fair manner, but people get too tied to these things, too emotional, and again, they're looking out for their division, as they should, without necessarily keeping the overall company profitability in mind. So we might have to go some other route in setting transfer prices. A lot of companies set transfer prices at either the variable cost or the full cost, aka absorption cost, incurred by that selling division. So potential drawbacks to that approach would be that using the full cost as a transfer price could lead to sub-optimization. The reason that happens is, let's think about what full or absorption costing does. We know this from our earlier study this semester. It includes as a product cost a whole bunch of fixed costs that might not be sort of changing or affected by volume. So if we include those in the transfer price, we might be giving a somewhat distorted picture of the true incremental cost of these products, and that might be hurting us as a company as a whole. Second, the selling division will never show a profit on any internal transfer. Again, that's by design, and that somewhat hurts the division if we think about it. Now, in theory, the performance measures that those managers are being evaluated with would certainly take those things into account, but again, it's something just to think about. And then third, cost-based transfer prices don't provide incentives to control costs. Right? If one division gets a whole bunch of their business from internal transfers, there isn't a whole lot of motivation to keep costs low because they know they always have guaranteed customers, in other words. So again, we want to make sure that all of this transfer pricing activity, all these internal transfers, are done with the welfare of the overall company combined, always kept in mind. Almost done. So transfers at market price. Market price, that's really just the price charged for an item in an open market, not internally, is often considered the best approach to the transfer pricing problem. This market price approach would work best when that product or service has a reasonable outside market. We can get a reliable price for it. So a couple other things for us to consider there. It also might work best when the product or service is sold in its present form to outside customers. So there's no modification required to transfer this thing internally, and the selling division has no idle capacity. Or second, a market price approach does not work well when the selling division has idle capacity. Right? Again, if we can sort of make it cheaper in-house and transfer it internally, we don't want to be considering the market price, which is set assuming we have no idle capacity at all. The principles of decentralization suggest that companies should grant managers autonomy to set transfer prices and to decide whether they're selling internally and doing these transfers or whether they're hitting the open market. even if that might occasionally result in what we'd call suboptimal decisions for the company as a whole. That way, in theory, top management allows subordinates to control their own destiny. So we're always thinking about this controllability principle in responsibility accounting. Managers should always have the decisions around things that affect them and their part of the organization, and this concept would sort of fit with that. But again, we do want to make sure that all of our internal transfers and our transfer pricing activity, to the extent possible, can really keep the big picture of everyone's combined welfare in mind. So let's finish this up here with a practice problem. It's not as bad as it looks. So the Southern Division of Barstool makes and sells a single product which is used in making trucks. The annual capacity is 12,000 units and the variable cost is $35 per unit. Presently, the Southern Division sells 11,000 units a year to outside customers at $49 a unit. The Northern Division would like to buy 4,000 of these things a year from the Southern to use in its production. There'd be no savings in variable costs from transferring internally. The lowest acceptable transfer price from the standpoint of the Southern Division should be closest to what? So pause that, do a quick calculation, then come back for the answer. That would be C, 4550. So how do we get to that? Well, the available capacity for outside sales is that total capacity of 12,000 units minus the 4,000 we'd be transferring internally, so 8,000 as a whole. The lost outside sales then would be the outside demand of 11,000 minus the 8,000 or 3,000. So the transfer price should be greater than the variable cost plus that opportunity cost, so the lost external sales. So 3,000 units times the $49 minus the $35 variable cost per unit means $42,000 in lost contribution margin from losing those external sales because of capacity issues. So the transfer price then, $35 plus the $42,000 in lost CM divided by the 4,000 units we'd be transferring internally, or a total of $45.50 per unit. Okay, that's what we'd set that lowest acceptable transfer price at. So that finishes up our notes for Chapter 11. Move on to the practice problems as soon as you can, and let me know if you have any questions.